Hey, how's it going, guys? I understand that most of you guys are extremely excited about the stock market right now, especially after the unbelievable earnings report from Amazon, Apple, and Facebook. Before you get too overexcited about chasing the stocks, I just want to make a very quick video to show you guys some of the extremely dangerous signals and the big potential risk that I'm extremely concerned about. The dangerous signals come from the bond market. The 2-year yield has crashed more than 12% today before the stock market opens, and it breaks this very important bear market support level. If the 2-year yield breaks this level, then the next target will be 0% or even the negative territory. Apart from the 2-year yield, the 10-year yield also crashed as well. In fact, it already broke this important support level and continues heading lower. 30-year yield is catching up the downtrend as well, testing the support level, and it seems to follow the 2-year yield and the 10-year yield trajectory to break down pretty soon. These are the very troubling signals to look at, especially when the stock market is trending up on extremely crazy earnings report. When the stock market price and the bond market price are both going up, I always listen to the bond market, because the bond market is the true battleground where it separates the FOMO crowds and the smart money who truly understands the economic truth. There are two key points I want to point out in this quick video. First, when the bond market is going up with the stock market at the same time, no matter how much you are craving for chasing your favorite stocks, please make sure you are not overweighting on US equities during this period. Because the bond market is screaming at us that the US equity are completely moving away from the economic reality. Of course, it's mainly artificially driven by the crazy monetary policies. The downside risk is way much larger than the upside return. I keep my US equity exposure around 25% at this moment, combined with around 12% emerging market equities. That is in total less than 40% equity exposure. The second point is even more important and something I truly worry even more. You see, among all those large institutional investors around the world, the pension funds, the insurance companies, and most of the stable mutual funds are the largest players in the market because they have the fixed annual targets that are either set by the government or the central banks that they have to hit every year to provide for their clients. In the past 30 years, the majority of their funds are in the US Treasuries because they're the safest and the most predictable asset class to invest. It fits their fund objectives perfectly. However, since this year's COVID-19 crash, the bond yield crashed to almost 0% territory. And that makes US Treasuries into a very interesting position that they are paying even way much less than the S&P average yield. If those pension funds and insurance companies are still holding US Treasuries, they will no longer be able to hit their annual target. And that will force them to add much more equity components into their portfolio and flood more money into the stock market, especially on those large cap tech companies with less risk. So if that happens, for the short term, the stock market will go up in a pretty strong momentum as the investors will be chasing to price in this scenario. And that will make the S&P 500 even more concentrated on the top 5 to 6 companies and accelerate the stock market bubble to pop even faster. And when the next big sell-offs happens, the scale and the magnitude will be way much bigger than what we saw back in March. This is exactly why Ray Dalio has warned us that the decade of 2020 to 2030 will be the last decade for the US equities. Well, the main reason for this quick video is just to quickly inform you guys some of the potential risk and the warning signs before you price that buy button on your favorite stocks. Just remember, in the world of investing, the dumb money plays the game trying to win, but the real smart money plays the game not to lose. When you chase your favorite stocks, do not forget to protect your downside risk as well, especially in our current market environment. Alright, that's it for this quick video. Look forward to seeing you guys in the next one. Stay safe out there, guys. Bye for now.